What a dramatic and tumultuous week it has been for global markets, including India. We saw the RBI announce an out-of-turn interest rate hike of 40 basis points and a CRR hike of 50 basis points as it looks to suck out excess liquidity from the system. Now remember, the inflation figures for India for the last month was somewhere around 7% or so, and the RBI expects inflation for April to overshoot that 7.5% mark. In light of this, the RBI had to act on interest rates and in tandem with what the global central banks are doing. Interestingly, the move came right before the Fed's rate decision as well. So the Federal Reserve announced a 50 basis point rate hike, which is the biggest rate hike in over 2 decades, as it looks to tame stubborn inflation, which is hovering at 8.5% in the US. However, the markets took heart from the fact that the US Federal Reserve has ruled out a 75 basis point rate hike anytime soon. However, after the markets digested the Fed's hawkish policy stance, they believe that if inflation doesn't get reined in quickly, there will be a slowdown in global growth, and that will lead to a situation of stagflation in the US. And because of these concerns, we saw the US markets tumbling on Thursday, and the Dow clocked its worst day in over 2 years. In fact, it has clocked a sixth straight week of losses, and the Nasdaq, well, that is down somewhere around 25% from its peak that we saw in November. In tandem with that, the Indian markets as well took a plunge, and in fact we saw the Nifty losing somewhere around 5% for the week, and investors have been left poorer by somewhere around 12 lakh crore rupees. This is just the beginning of a rate tightening cycle, and the RBI has just about joined in its global peers when it comes to raising interest rates. So even in June we can expect a rate hike by the RBI, but in such times when interest rates are going up, inflation is high, and there are fears of growth slowing down from current levels, what should investors do? Well, when it comes to building your portfolio, first of all, experts believe that this is the time to stay away from stocks which have high FII holdings. Now, FIIs tend to withdraw their money from emerging markets when the Federal Reserve raises interest rates, and that's because their cost of borrowing goes up. So in that sense, we have already been witnessing FIIs pulling out money from the Indian market. So in that sense, it is prudent to stay away from stocks that have high FII holding. But most people look to enter the markets on dips, but at a time when interest rates are going up, when inflation is high, and when there is a fear of slowdown, it is advisable to enter stocks, large cap stocks, which have lesser debt on their books. But experts do believe that it's time to steer clear of mid and small cap companies which have heavy debt on their books because of the cost of borrowing going up. When it comes to equity mutual funds, it's the same funda. Equity large cap funds are expected to do well, but there could be a lot of volatility when it comes to mid and small cap funds. But investors must continue with their SIPs because it's a tool to build wealth over the long term. When it comes to investments in the debt markets, well, experts believe that fixed income investments or products with short-term duration is advisable, because if you go for a product with a long-term duration, every time there is an interest rate hike, it will hurt your investments. So you can look at investing in debt funds of short-term duration, or which have maturity of somewhere around 3 months or so. In fact, you can also look at floater funds where interest rates can be adjusted upwards according to the prevailing interest rate in the market. Well, in fact, investors also prefer to invest in gold at such times, which enjoys a safe haven tag and is looked upon as a hedge against inflation. However, do remember that there is a fair bit of volatility in the gold prices as well due to the strength in the US dollar. Well, volatility is the name of the game, and technical experts are predicting more pain on the charts for stocks going forward. So in such a situation, experts advise investors to stay away or to refrain from taking aggressive bets into the markets, and to take advantage of the correction to accumulate stocks which have low debt on their books and which have strong balance sheets, because that will help you create value over the long term.